Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler. Talking money and investing. Educating. Letting you in on some of the investment industry secrets. Because the more you understand this stuff, the less you're going to get taken advantage of. I had a lady I was talking to today, as a matter of fact. I listen all the time, and I said, do you understand? No, I don't understand everything. But it's entertaining, number one. Because I like to joke around, I suppose, when it's appropriate. But also because, it's just, I'll pick up something, she said. And I appreciate that. Probably even listening now. So I just appreciate those comments because sometimes I wonder, am I going over the head? I'm going to try not to, but there is something really, really important I want to talk about right now. I got a mailing, and the mailing was to go to a steak dinner. And I don't eat steak or chicken. It's not because of, animal rights or anything. It's just because I have had really high cholesterol levels, and I had to get them down, and I had to make sure I took care of myself, and that was one of the ways I was supposed to take care of myself, is just get away from that kind of stuff. So thanks for the steak dinner, folks, the financial planners that are trying to invite me out to their dinner, but no thanks. But you have given me something really good for the radio show, because... And I have to advise people, if you want to, don't take me off your mailing list if you're a financial planner trying to get me to go to your steak dinner. It's really bad for your business for me to get your invitations because I'm going to pick on them. But it was, hey, I was taught to do the same thing back in the day. I never did that, but I was taught, they were taught, hey, do this. They taught us to go and get people into steak dinners, get them into restaurants, college campuses, because you get the gravitas that comes with the college campus if you're teaching a class on the college campus. Yeah, it looks like you're actually endorsed by the college in some way if you're renting one of their rooms. So, quite often that will happen. Or, I don't know. There are other places, I suppose. I can't, public libraries. That was another one. That was, if you rent the public library, it makes it looks good. But anyway, so I got this thing, and it said it was talking about, there we go. Will I outlive my money? That's the question, the number one question that retirees or those nearing retirement are asking. And that is very true. There are a lot of people that are worried about outliving their money. And when you go to one of these workshops, in this particular one, they're going to talk about access to a source of income that's rarely considered. It could be possibly reverse mortgages. Maybe that's what they're talking about. Yeah, people don't typically think about that. I'm just guessing as what they might teach. Pay dramatically less taxes in retirement, including no taxes on Social Security benefits. Of course, you can go and convert your IRAs to Roth IRAs, pay a bunch of taxes now. It's not that you have avoided taxes. You just shifted it to a different point in time. And sometimes it does make sense. A lot of times it may not necessarily make sense. It really, really depends on the situation. You can pay no taxes on Social Security. You can have no income. That'll take care of that as well. Protected against inflation. I'm going to take exception to what they're saying as how to protect against inflation, and it's annuities is really what they're getting into in here, and indexed annuities where you can participate in market returns. And I'm going to hit this in a little different way than I normally do, but I'm going to hit something that I think is really important, is how to protect myself from outliving my money. And I'm going to talk about a workshop that I taught a little while back. And I talked about, hey, this is one of the things that the government got right. And a lot of people like that particular title because does the government ever get anything right? And yeah, the answer was yes. In this particular case, the way the rules are written to take income from IRAs, it can be very, very beneficially done, the way of taking income if you follow these rules. And I'll talk about that in a second. And a shrewd tactic to guarantee you'll never run out of money. Well, that might be, I don't know, that could be just about anything. Annuities typically are the way to never run out of money because you actually put money in an annuity and it pays an income for your rest of your life and you can't run out of money. But there are problems that you don't necessarily pick up on when you use these products that I've talked about before, but I'm going to talk about in a little different way than I normally get into it. So one of the things that I was talking about was this workshop that I had done a while back. And the workshop was, did the government get it right? RMDs, required minimum distributions. Now, the idea behind your IRAs or your 401ks is you're putting money away right now. You're putting it into, let's say it's a pre-tax traditional IRA or 401k. And I'm saying, don't make me pay taxes right now. I don't want to pay taxes right now. Let me pay taxes sometime in the future when I'm not working anymore. And when I'm not working, I don't have, my income level is much lower. So therefore, I have some income that I can earn, and the tax rate on that is 0. And then I have some incomes taxed at 10%, have some income that's taxed at 12% and 22 and 24, and the tax rates go up as your income goes up. Well, a lot of times when somebody's working and they put money into a 401k, they can avoid that 22, 24%, up to 37% tax rate when they put the money in. So they go, I got $10,000 and I want to put it away. And if I put it away and I pay taxes on it, and if I'm in a 37% tax bracket, I've got $3,700 in taxes that I have to pay right now, and I'm only left with $6,300 to invest in something. Well, why don't I put the full $10,000 into the pre-tax 401k or IRA if, IRA limits are lower than that. But if I can do that, then I don't pay that tax right now. That money that would have been sent to the government in taxes can earn income for me or returns for me. Then I'll take it out in the future where I get to earn a lot of money. And if I'm married, finally jointly, it's almost $30,000 where I pay no taxes on it. So I can earn income and I have no taxes on it whatsoever. Next $20,000 approximately of income, taxed at 10% and so on and so forth. And I look at that and go, wow, that'd be kind of nice. If I could avoid a higher rate right now and then take it at that lower rate, that's tax leverage. Good deal. Makes a lot of sense. Why pay taxes right now if I'm not using the money right now is the idea behind that. So hence, that's why pre-tax type of investment vehicles have always been so popular. Now, if we think about that and now we go and say, okay, so what happens if I go Roth IRA? I'll be paying taxes now and I may be avoiding lower tax rates in the future. And that's why Roth IRAs don't always make sense for people. Now, with the required minimum distribution, let me come back to that because the required minimum distribution does not apply to Roth IRAs, but it does apply to pre-tax IRAs. So how does it work? Well, what it does is it takes a look at what your age is. And required minimum distributions, the rules have been changed where if you're not already taking them, you weren't already taking them when the rules changed, then what happens, you may be subject to a couple different ages that you have to start taking these distributions. And one of the ages is age 73. And then for people born a little bit later, goes after the 1960s, it's 75, okay? So what happens is you'll have this situation where you don't have to take it. But what is the formula based on? The formula is based on if you were age 73, they're imagining that you're married to somebody age 63, 10 years your junior. So therefore, if you take two people, one 63 and one 73, their joint life expectancy would be longer than someone who is just age 73 because you got the younger person there. So what happens is that reduces the amount of money that has to come out. It reduces the percentage. So the way it works is you take the dollar figure in the IRA, divide it by the life expectancy, and if that number is, let's just use 25 because it's a nice easy number to deal with, If I've got 100,000 and I divide it by 25, that equals 4. That's your percentage that has to come out of your account value. Then every year you get older, your life expectancy goes down some, but not completely, because what happens is, like, when you're born, let's say that your life expectancy is 76 years old. Let's say that that's what it is. Well, when you reach age 76, your life expectancy isn't 0 years. You've been through a lot of the junk that takes people out, like infant mortality or crazy stuff that kids do or teenagers do, or crazy things that happen, little dread diseases that come along that take people out in their 20s and 30s and 40s and 50s, and heart disease and those types of things, cancer and diabetes and all of those types of things. So what happens, you made it to age 76. Therefore, you've sidestepped a lot of those time bombs from 0 to age 76. So therefore, you still have life expectancy, okay? So what happens is they have a life expectancy for you at that particular age, and they will divide your account value by that life expectancy, imagining you're married to somebody, even if you're not married. Imagining you're married to somebody 10 years younger than you. So what happens is that I can take this income, and it's a percentage of the account value, and I don't worry about running out of money. Why? Because I'm always taking a percentage of whatever is there. And because I'm taking a percentage of whatever is in the account, and I'm not taking and running it down, you don't run out of money in that particular instance. Now, you got to be really careful, though, what you're investing in, because you may not run out of money, but you sure may run out of purchasing power. And what I mean by that is that, let's say you're taking money out of, let's say, an annuity. And that annuity, the way an annuity works, it's going to look at life expectancy. And in general, I'll just talk in general, an immediate annuity. Let's say, I'm going to oversimplify because that's the way I like to do this, so it doesn't become too complicated. But let's say I have a person with a life expectancy of exactly 10 years. And their joint life expectancy, if they do it jointly, is 10 years, whatever. Let's just use 10 years. And you hand them $100,000, and you hand the insurance company that amount of money, and you say, hey, here's $100,000. What's my life expectancy? They're not going to tell you, but they're going to have actuaries that figure it out. And they say it's 10 years. So what we're going to do is, let's say that the interest rate is non-existent, just to keep this really, really simple. And let's say the insurance company has absolutely no expenses whatsoever. So what are they going to do? They're going to pay $10,000 per year in my example. And then at the end of the 10 years, the money would have been gone had you done this trick on your own. Now, if you live beyond the 10-year period, they're going to have to continue making payments to you because it's an insurance company. They're taking the risk that you live longer than your life expectancy. If you only live 2 years, they've only paid you $20,000. You gave them $100,000. You lose. Your heirs lose. The money's gone. That's the way an annuity. That's just a really simplified way of understanding this idea of how an annuity is designed to work. And by the way, because you could end up having payments only for a few years and die and the money's gone, and your heirs don't get anything, especially as people get older, their desire to leave something to their heirs tends to increase, and they don't necessarily like that idea. That's why almost nobody ever annuitizes these contracts. But I'm using that as an example because that's what they're marketing at these workshops as annuities, and they're saying, hey, guaranteed, you can't ever run out of money, you can't ever, so that's how you get that guarantee you can't ever run out of money, is by doing that. Now, what happens is with the required minimum distribution is that it is based on a percentage of the account value. Now, with an annuity, let's say, and I use the example from there was this website. I've talked to this guy before. He runs this immediate annuities website, and you can get kind of quotes on these types of things. So I like it. I can use it as an illustration all the time. But let's say that I had $300,000 and $200,000 I just had in my IRA in regular investments, and the other $100,000 I had in an annuity, and I was going to use an immediate annuity. Now, the way the required minimum distribution works is they're going to take a percentage of the account value. So if you have a 25-year life expectancy, account value divided by 25 is 4%. Then let's say that your life expectancy, drops down to 20 years. Then it's going to be account value. Let's say it's 100,000 divided by 20, and that's 5. So that's 5%. So as you get older and your joint life expectancy of the 73-year-old married to the 63-year-old is declining because now they're 83 and 73 or 94 and 84, so on and so forth. As that life expectancy goes down, the percentage goes up. But you're getting older and you don't have as much time left, so you're taking a higher percentage of the portfolio. And I'm going to get into how those numbers work out based on that workshop that I taught, because it's really cool when you look at it and go, oh man, the biggest thing that I worry about, and here are the numbers behind it, then you start to feel a little bit less concerned about this type of thing. But let's say that I had the $200,000 in the regular account, $100,000 in the annuity, and I annuitize it, let's say. Well, the annuitization of that contract helps me meet that RMD. It's not included in my required minimum distribution calculation. The $200,000 is considered, and then they make me take out 4% or 5% or whatever from that. That $100,000 is based on life expectancy, and then it meets it, so I don't have to count it in the required minimum distribution. Now, that may sound good, but in a second, I'm going to come back and I'm going to walk you through how it may not so necessarily be so good, and it can actually be kind of, So hang on to this thought, and I'm going to walk back, and hopefully I won't have to recap too much to help you stay with me on this, because this is really, really important stuff, and another reason that you got to watch out what you're taught at these workshops. Okay, so this all started talking about this workshop invitation sent to my house. Worst place to send these types of things, but that's what happened. It was how to not outlive your money is the biggest concern that people have. They don't want to outlive their money. And annuities are often the example of something you can use to not run out of money, because they're basically taking the life expectancy that risk on themselves as the insurance company, that if you live too long, that they're going to have to continue to make payments to you. Now, if you go to this website of this one that on immediate annuities, this guy actually gives an example. He says, if you transfer $100,000 to an IRA annuity at age 72, you may receive $7,250 a year, or 7.25% of your premium and annual income. So you got $7,200 approximately. And remember, I said when you first start taking a required minimum distribution, they're going to look at you and imagine you're married to somebody 10 years younger. So therefore, it'll be just under 4%. So if I have 7.2%, what does that mean? That means that they're forcing more out of the account than an RMD would have required. Now, the government loves that because they get their tax money earlier. But you may not love it because you may be ending up paying taxes in a higher rate than you would have, number one. You're getting more income, but the problem is you're paying taxes at a higher rate. And what happens, this is really important to understand about our tax system. If you look at the way the brackets are set up, the tax brackets, your first income is taxed at zero. Remember, it's like about $30,000, right? Just under $30,000 of income, married, filing jointly, that you don't have to pay any taxes on. And the next 20 is 10%. Well, if we look at that and we say, okay, so what happens to those tax brackets? Well, as time goes on and inflation erodes the purchasing power of the dollar, those tax brackets go up or the incomes go up, and then you're taxed at lower rates for higher and higher amounts of money. An example to help you understand this is that let's say if I'm looking back in the 1970s and I was making like $7,000, $10,000, I was pretty normal for a family making that level of income. Now, do you think not only could I earn $7,000 or a normal family income, but even another $20,000 above that I would be taxed at 0% in the 1970s? No, that doesn't even make sense. We all paid taxes in the 70s, right? Everybody, parents, so, I wasn't working a normal job. I was cutting grass back in those days. But my parents were making normal incomes and paying taxes just like everybody else. They weren't exempt from them. So why are we exempt from taxes for so much more income now? Because the purchasing power of the dollar has gone down by that much. By that much. I mean, think about it. I couldn't possibly live on $7,000 now. What are the implications of this? Well, the implications are that if I'm earning $7,250, which is what this annuity, $7,250, right now, in 20 years, if I have a 4% inflation rate, the purchasing power is only $3,200. Well, so maybe because of the way tax brackets are indexed, my income taxes will be less. But the problem is that tells you something else. If the income tax brackets are that low in the future, that must mean the government feels sorry for us because they're not even willing to tax us on it anymore because we must be poverty level. It's just another way of looking at this. I mean, it's kind of a funny way of looking at it. It's not that funny. But that's the problem with these annuities is that you go and annuitize it and then you get the same level of income forever. And that income level may be fine right now, but in the future, it's just not going to be there for purchasing power purposes. And the problem is that we've gone broke safely, is in essence what we've done here. Now, the other thing is that, they'll have indexed annuities and they talk about that. And there was a really good article. One of the fund companies out there had an article on this. And they were talking about the elements of indexed annuities that people just don't really understand. And it says they often misunderstand the calculation of the investment return credited to your account. Now, and I'll tell you where to find this because, I have lots of things that I look at with a lot of these big fund companies, whether it be Vanguard or Fidelity or what. This is Fidelity's website. But in this particular article, I think they did a really good job of explaining the problems here. And they said that, one of the elements of the fixed annuities is misunderstood is the calculation of the investment return and how the insurance company calculates the return and how much of the index return is credited to you. This is the key problem. It's how they actually credit these returns. Now, number one, they have lots of ways that they actually limit this so that you don't get a lot of the returns that the market delivers. And they tell you how you can actually get benefit and protect yourself from inflation, all that stuff, which is not necessarily the whole story because of the problems with the crediting of returns. Number one is the cap. And the cap is the upper limit, as they explain here, over a certain period. For example, if the index, let's say the S&P 500, the Russell 2000, the Europe, Australia, Far East, or whatever index is being tracked, an index is just a segment of the market. The S&P 500 is just the 500 biggest companies, and the growth in those companies is capitalization weighted, so it's mainly dependent on the very biggest companies in the index, but it's those different areas. Now, if the index returns 10%, but the annuity has a cap of 3%, which is not unusual to see, your account receives the maximum return of 3%. And said that many indexes do that. And here's the one thing they didn't put here, but let's say that the market goes down, they can take away all of the up return. So if the market goes up 10 in 1 month, so you get 3% of it, but it goes down 4% the next month. Now, you would have had a positive return, up 10, down 4. You still have a positive return if you own the market. But in this product, if it goes up, you get 3. If it goes down 4, they take away the 3. They won't make you go below 0, but that's what happened. You lost all your return, even when the market did what it did. And a lot of people don't recognize that that's what happens. Participation rate is another thing. This is where the market goes up 8% and your participation rate is 80%, is the example they use here. Well, 80% of 8% is 6.4% return. That's the return you get. Sorry, Charlie, that's what you get. 6.4%. Now, that's forgetting about the dividends, which I'll get to in a second, because that makes it even worse. Then they got the spread, margin, and asset fee. So they'll have, if they have a spread fee of a couple percent, they take away return there. But most of the time, a lot of times, I don't see where they show visible expenses in these products. So I'll go to the next one. Bonus. They give you a bonus. Hey, if you put money with us, we'll give you a bonus if you'll put money. Well, where's that money come from? They're not running a charity where they're bonusing you and increasing your account value. It's coming from somewhere, and it's coming from you. I won't get into that because it's too complicated right now. But just recognize anytime they're telling you that there's some kind of a free lunch for buying their product, there's no such thing as a free lunch. In addition, one often overlooked point they say here is that for the purposes of the insurance company calculation, an index return excludes dividends. And people do not recognize what a big deal that this actually can be. They use an example here. For example, over the past 20 years, ending December 2021, so this article is written somewhere in 2022, I guess, the S&P 500 has gained 7.8% annually without dividends and 9.52% with dividends. So I just did a calculation. If I put $100,000, that's $100,000 growing over that 20-year period to $616,000 with the market, but only $415,000 if you excluded the dividends. That's $200,000. $200,000 on a $100,000 investment. After this, I'm gonna keep walking through some of these problems because you need to understand this stuff. And then I'm gonna walk through, before this gets over, I'm gonna walk through actual client returns, and I'm actually gonna walk through how I like the way the required minimum distribution calculation works, where the government got it right, in my humble opinion. Back to this, the example here, which was on the indexed annuity and, what actually happens with these products. And, they talk about in this little piece that was on Fidelity's website, they don't have an upfront sales charge. They talk about indexed annuities have hidden costs that are passed on to customers by the insurance company. That's key because often you hear no expenses. No, it's all good. You don't have any expenses. And, it's the insurance company, out of the good graces of their heart, they pay me for recommending this. And I've heard that before. But, I look at any kind of a commission as you get a conflict. The advisor doesn't get paid unless you sign on the dotted line. And that can be a real problem because they're paid up front. And there isn't the great incentive to service you down the road 1 year, 2 year, 3 years, 4 years, 5 years. Well, we don't need to service you because you got the product. And yet it's amazing how often I see them say, oh, that annuity I sold you, 7 years ago, we need to update it. There's a better product out there right now. And then all of a sudden you pay another commission and that happens. I see that quite often. But what happens is you'll own this product and there'll typically be something else that comes out that has a shinier hook on it or whatever. But often you hear, oh, no expenses. No, there are. I like this. They have hidden expenses, and that's exactly right. And then you've got the limiting potential on returns of participation rate, the cap, and the spread. And the other thing is that can you lose money? And in here, often you hear you can't lose money. It's guaranteed you're not going to lose money, But what you don't necessarily hear is yes, you can. And that's what they say here in this wisely. The answer is yes. If the market index linked to your annuity goes down or you receive no or minimal index linked return, you could lose money on your initial investment if you withdraw assets before the surrender period is up. You need money for something. I had an unexpected expense. And that's another problem with the annuity. Back there, let me go back to the annuity that pays an income for the rest of your life. You get older and you go, well, wait a minute, I can't live on this small amount of money anymore. When I first took out the annuity, this level of income was fine. I was able to live on that just fine. Thanks. I paid lots of taxes on it, and the government went to hey, I wonder if I can go to the government and have them send some of that tax money, the overage in taxes that I paid early on, because the distribution for the annuity, when I annuitized, and if you missed the first part of this where I was teaching on it, go back and listen to the podcast at paulwinkler.com. But you end up having a higher percentage than what is actually required quite often. I say quite often because there's some annuity products that are so bad that it's actually low. But anyway, it's a higher percentage. And you go, hey, I paid taxes on a higher percentage. I wonder if I can go to the government and get a refund because now I'm broke. And they feel sorry for me, and I'm in a 0% tax bracket as a result. No, they're not going to give you a refund. This doesn't work that way. Just not going to work that way. Although, you can give it a shot. But kinder, gentler IRS may be in power at that time. So what ends up happening is that, with this annuitization, I end up with that same level of income on into the future. And I'll say, well, wait a minute. I wonder if I can go back and take some more money, just pull some money out. No, when you annuitize, in a regular straight and immediate annuity, your access to the cash, it's gone. Now, there are some products that do overcome that particular that particular issue. But here's how they do it. You ready for this? They reduce your income throughout the entire contract. There's no such thing as a free lunch. So they reduce it. And then you're like, oh yeah, I have access to money, but I had a reduced income the whole time. And you think, well, wait a minute. Anytime I get something, I give up something. That's life, isn't it? So what happens with these products, and if you look at the actual calculations on returns, and they had that actually in this Fidelity article. Over the 10 years ending December 2021, the S&P 500 average return was 16.63, which is higher than historically normal, I will just say, where that's $100,000 gross $465,000 without dividends. Whereas if you look at the indexed annuity, what did it return in Fidelity's example, whatever product they're using here? 2.79% annually. 2.79%. So on a $100,000 investment over just a 10-year period, that's a $334,000 difference. And you want to read this article for yourself. It's what are indexed annuities. It's one of the better things I've seen out there on the particular topic. But this is what people are getting pulled into all the time. In index universal life, I see that a lot, and I go, oh my goodness, you do not want that. So what I'll do, I'm going to do this because it would be a really good breaking point to take a quick break right now and then come back and explain this workshop. You don't want to miss. I'll talk through this particular workshop that I taught, and it was on taking income and the required minimum distribution and whether the government got something right. Typically, you'll hear workshops from financial people taught on, tax issues and things like that. There was an article that recently worked through what's the biggest issue, what is by far the thing, and they had this correlational study where they were actually looking at what well-being was in retirement and what one factor lined up with whether well-being was good, bad, terrible, great, whatever. And it was stock and bond market returns. And often what people talk about is everything but. They talk about taxes. They talk about IRAs, traditional IRAs versus Roth IRAs. They talk about Social Security and which Social Security can be a huge part of retirement income. But they typically don't really talk about academic research and investing. And what I found when I was a broker, it was because we weren't doing it. When I was a regular investment advisor working for the big investment firm, and even some small investment firms, it was just not what we were talking about. We were taught to sell product, sell annuities, sell life insurance. You might have some managed products and things like that, managed investment accounts and those types of things in your basket of goods. But it was sell whatever you could sell. And that was, do estate planning. So you could, sell products in that particular area and real estate investment trusts and limited partnerships or whatever. But it was very rarely talking about academic research and investing. So, hence, quite often what people are doing is they're just being sold something and they don't necessarily recognize that's what's happening. So what I did was I did a workshop answering the big question that people have, which is, am I going to be okay? Will I outlive my money? Will I be okay? And the thing that hit me as I was thinking about this is that required minimum distributions are a beautiful thing. We often go, oh man, I got to take money out of my account but for a lot of people, if you look at the vast majority of people, they actually take out more out of their account than the required distribution is. And quite often they take out more because their income, their returns, the way their portfolios are invested is so bad they have to, just in order to get by. But what the example that I like to use is why the RMD, the required distribution. Now, with Roth IRAs, you don't have that. With regular IRAs, you do. And here's what I like about the required minimum distribution. It's a percentage of whatever is in the portfolio. You can't run out of money if you're taking a percentage of whatever's there. When you first start, your required distribution is 4%, and then it grows when you're about age 90 or above age 90, actually, it will be about 10% or in that neighborhood. So it grows from 4 to 10, but you're always taking a percentage of whatever's there. So I can't run out of money if I'm taking a percentage of whatever happens to be in the account. Now, that's why it's so critical to make sure that the investment part is being done correctly. And there's a way that you take income from an investment portfolio. I don't have time to get into that right now, but the short version is if I have 20 different asset categories, and all those different asset categories long run have a positive historical return, large companies, small companies, large value, small value, international large, international small, international large value, international small value, emerging markets value, emerging markets small, 5-year bonds, 4-year bonds, 3-year bonds, 2 years, so on and so forth. All these different asset categories. In any given year, when I design a portfolio, I have something that's doing okay that I can take income from. So if large U.S. stocks are down in a given year, I don't want to sell them when it's down. So I'll take it from, let's say, my 1-year bonds or my 4-year bonds or my 5-year bonds, or I'll take it from my small value stocks, or I'll take it from my international. So I'm taking it from whatever happens to be holding water in that particular year. And that is hence, how the academic research shows taking an income from a portfolio. So what I've got to make sure is I'm well diversified like that. And I've got all those different things. Now, what I did is I actually took what are called GIPS audited returns, and I opened the company here in the year just before the year 2000. So my first full year of operation was the year 2000. But we have data on the portfolios that I use going back to 1990s, early 1990s, 1991. And what I did is I interpolated, which is a fancy term, going, okay, we audited the 50-50 portfolios, half stocks, half bonds, and we audited the 75-25. So we interpolate to figure out what a 60-40 mix would be, because I use 60% stocks, 40% bonds quite often. And what I did is I started with a required minimum distribution, and I took that out every year. Now, the first distribution was just about $3,700, and that distribution grew to just under $80,000 over the last 22 years. So the income started at around just below $40,000, and it grew to over $60,000, about $80,000 over that period of time. And that's what I needed to keep pace with inflation. I didn't quite need that much. I needed $36,000 to buy what I bought in 2000. So $36,000 is what I could have bought. Now I need about $60,000 to buy what $36,000 used to buy. So I kept pace with inflation and only had 2 years where my income was a little bit less than what inflation would have said I needed, but it wasn't much. So hence, I didn't run out of money, and I still had the account value. And hence, that's why I like the required minimum distribution. It's because I'm only taking a percentage of what the portfolio is. And it's backed by a lot of academic research on how to take an income.